Good morning. Welcome to the Heritage Foundation and our Lewis Lehrman Auditorium. We, of course, welcome those who join us on our heritage.org website on all of these occasions. For those in-house, we would appreciate your checking that our mobile devices have been silenced or turned off. For those watching online, you're reminded you're welcome to send questions or comments at any time, simply emailing speaker@heritage.org. Hosting our special guest today is Adam Michel, who serves as a policy analyst in our Thomas A. Rowe Institute for Economic Policy Studies. He focuses quite appropriately on the economics of taxation, international tax competition, and the federal budget. Before joining us here at Heritage, he was a program manager for the Spending and Budget Initiative at Mercatus Center at the George Mason University. Please join me in welcoming Adam Michel. Adam?
Thank you. So today is an appropriate day to talk about the economics of tax policy and what we hope to see the economic consequences of the tax reform plan that is being rolled out as we speak. The Ways and Means Committee is right now releasing the initial details of the tax reform plan that's been under discussion for quite some time now. And the biggest pieces of that will be, or the most important pieces of it for the economy will be the economics of the business tax code, how reforming business taxes can unleash economic growth and sort of help average Americans. So here with us to discuss that issue is Kevin Hassett, who's the chairman of the Council of Economic Advisors, which is essentially the think tank in the White House, helping explain all matters of the economy. Prior to becoming the chairman of the CEA, Kevin was an economist at the American Enterprise Institute, where he held a number of different roles. He was the senior economist for the Board of Governors for the Federal Reserve System and an associate professor of economics and finance at Columbia University. He's a noted expert in the field of public finance. He's published in peer-reviewed journals, many of those articles on the topic that we're going to discuss today. So it's a pleasure to have you. Thank you.
Thanks so much. It's great to be here.
Yeah. So I guess I want to start with, before we get into tax policy and some of the things you've been recently writing about, I want to start with what your assessment of the economy. So what are the problems out there that we should be thinking about how to address?
Sure, thanks. I think the thing that is the most interesting and challenging for economists about the economic patterns over the last few years is that we're in a very unique time in economic history in that America's businesses have been prospering, but America's workers have not. And we looked at data going back to the Second World War, and it was typically the case that if you had a significant profit growth, then almost one for one you'd get significant wage growth too. But now, over the last 8 years, we've had 11% profit growth per year, but almost no wage growth. And so the puzzle then becomes, well, what explains the disconnect? We used, fancy econometric techniques to estimate about when this started to change, and it started to change in the 90s, but it got way worse in the 2000s. And I think that the headline answer is just very, very simple: that the rest of the world has recognized that if they're a friendly climate for capital, if they're attractive to capital, then firms will locate businesses there and drive up wages because labor demand is high. And we haven't really changed our policy while everybody else has been. And so businesses are making lots of money, but it's not benefiting America's workers, because the profits are in Ireland and other places, and they're helping workers over there instead of workers over here.
And one of the other things I think I've heard you talk about is the change in that capital formation here, that's significantly lower than the historic average.
Sure. The one way to look at it is that there's something that economists call capital deepening. And what it means is just that, like, suppose that I ran a lawnmower business, which I actually used to do that when I was a kid, and then I spent all my profits on comic books, I can remember. But if you go back and if you invest in a faster lawnmower, then you can mow more lawns, and so you can make more money. And then I can remember my first lawnmower was not self-propelled. And then I got a self-propelled, and so I was able to mow more lawns because it was a little bit faster. And then I got a riding mower, and I was even faster. But then the riding mower was a disappointment to me because it was bad at the edges. Because if I tried to get the edges, then I would run over the shrubbery or something like that. But anyway, so the optimal for me was just the self-propelled, and but it really improved my wage because I could do more lawns, and so capital deepening is just sort of that it's when businesses invest in workers and giving them the machines they need to be successful. And over time, going back to the Second World War, this better lawnmower effect added a little bit less than 1% a year to real wage growth and productivity growth. And over the last 4 years of President Obama's term, this capital deepening actually contributed negatively to growth for the first time in U.S. history. So there was so little capital formation in the U.S. that capital deepening, it was kind of like you traded from the self-propelled back to just the purely manual lawnmower. And that's why wage growth hasn't been what it should be. And I believe that the tax plan that the president has helped lead us to is a tax plan that could reverse that trend, could create capital deepening that's back to normal. And if we get capital deepening back to normal, we'll have wage growth that's back to normal as well.
So I know you've released 2 reports recently on this question of how tax reform affects these sort of problems that you have identified. Can you give us a brief summary, sort of what you've found in that research?
Sure. So, and if you go to the Council of Economic Advisors website, then there's a good chance you'll find the studies there. I'm still getting acclimated to interacting with the IT people at the White House. It's difficult, like it always is in every organization. But yes, I'm pretty sure that you'll see them. The first study looked specifically at literature that has studied how worker wages have responded in countries around the world when those countries have cut their corporate rates. And so there's a lot of countries in the world. There are a lot of years in the database. So there's a lot of variation you can study to look to see, when this country or that country cut their corporate rate, then did wages go up or down? And we take that really big literature and map it to what would happen if we cut our corporate rate to workers. That literature is kind of a direct link. And that was study 1. Study 2 looked at some of the other indirect links potentially between corporate tax policy and wage growth. So, for example, there's a literature that I participated in way back in the 90s on the cost of capital, which is influenced by interest rates and tax policy. And you can take the tax plan, the corporate tax plan, estimate the impact on the cost of capital, and then say, well, if the cost of capital goes down by that much, then how much does investment in things like lawnmowers and capital machinery go up? And then from that, you can back out what should happen to wages, right? So it's a little bit more indirect. There's a literature that looks at how GDP changes in response to corporate taxes rather than wages. And then there's a literature that uses, like I know at Heritage for the longest time, there's been this great big fancy computational computer model of how the economy works, and then there's been a bunch of studies that, well, if you change taxes, what happens in that? And basically across all 4 literatures, we get that workers would benefit enormously from this tax plan, and that the wage gain of about $4,000 per family is a very, very conservative one. It could easily be double that or more.
Thank you. So I am sympathetic to the sort of how you describe the literature, but when I'm talking about these issues, I often consistently get some pushback from people. So I'm going to try a couple of these questions out on you to sort of get your response, help improve my responses. The first is that the corporate tax only accounts for about 10% of federal revenue. How can such a small source of revenue have such an outsized effect on the economy?
Right. That point will be known in economic history as the Summers blunder, I think. That for those who study it, so the basic idea is that let's think again about the corporate tax. Right now, we have about the highest tax on earth, but we have almost no revenue from the corporate tax. In fact, our revenue to GDP is on the low end compared to our trading partners, and that's kind of what Art Laffer always talked about, right? Like if you have a really, really high tax rate, then you don't necessarily get a lot of revenue. Think about it this way. If we were to increase the corporate tax rate from 35 to 40%, how much more revenue do you think that the U.S. would collect, say, from Apple or from a drug company or from a medical devices company or any of these organizations, multinationals that have subsidiaries in low tax countries? Then, well, the answer is that if we went from 35 to 40, then what would happen would be that they would move more activity offshore, and we'd get almost no revenue at all, right? We were already barely getting any revenue out of the highest rate. If we went to even higher rate, then they'd just be more aggressive about avoiding the tax with lawful tax planning. And so the revenue from that 5% increase is zero. But how do they get the money offshore? Well, they build a factory in Ireland. They hire Irish workers. They increase the demand for Irish workers, and Irish wages go up. And they don't build a factory here, and so the demand for labor goes down, and wages go down. And so with no change in revenue, we get a loss in wages. And so if you wanted to take ratios, as some critics like to do apparently, you could end up with things exploding to infinity because the wage change is infinity times zero. It doesn't even get you there. And so when you see things blowing up like that, then a prudent person would say, oh, I should study this and figure out what I'm doing wrong. But some people unfortunately have decided that it reveals a flaw in our analysis, which is just incorrect.
And this is where I think I've heard you talk about this, that the dollar value of the corporate tax can actually be shared by workers through lower wages, but more than 100%. So this is a more.
But that is right. As a theoretical possibility, that's true, but that's not a key part of our analysis at all. That even with very very small shares of the worker burden, you can get pretty high wage effect. But again, the idea is that if there's so suppose that if there was no tax at all, that we would get 100 units of economic activity, but then we have this really high tax and we smash it down to 50 units of economic activity. Then we lose 50 units when we go from 100 to 50. And when you're thinking about what's the damage from the tax, you have to look at that sort of loss as well. And I think that the deadweight loss from capital income taxation in the U.S. is just enormous because of all this transfer pricing and location of activity offshore. And I want to just be clear that I don't criticize businesses for doing that. They're lawfully using the tax code, and it's their fiduciary responsibility to maximize the return to shareholders, and they're doing that really at the expense of America's workers. It's not that they're cheating, it's that our tax code is silly, and that we need to help them stop that. There are a lot of ways to put the scale of this problem in perspective, but this is the one that I find most striking. That again, the way I move my profit to Ireland, if I'm a company that wants to do that, and Kevin Hassett, by the way, is an Irish name, so I don't mean to pick on that country too much. But suppose I want, but they have been very effective at this, even posting economic growth. You go look, it's in the 20s. But so if I want to move something to Ireland, then the way I do it is I put a subsidiary in Ireland, and then I pay my subsidiary too much for the product so I used to make the thing here, I'd make the microphone here, and now I have a subsidiary in Ireland. It makes the microphone and then ships it back to the US. And so when you do that, then you increase the trade deficit, because the thing we used to make here, we're buying from our own sub from abroad. And there's a National Bureau of Economic Research study that came out last spring that estimated that right now 52% of the trade deficit in the U.S. is coming about because of the transfer pricing of U.S. multinationals. So more than half the trade deficit is because of this thing. And so now imagine that we've built this really silly tax system where more than half the trade deficit is attributable to lawful tax avoidance by U.S. multinationals. Then if we change the rate to 20, do you think that's going to have a small effect or a big effect? Because we're talking about something that's created, it's doubled the trade deficit. It's doubled the trade deficit, more. And so obviously it has to have a large effect, and the naysayers are incorrect.
So I've also explained this, I think, to a group of students just yesterday or the day before, trying to walk them through these effects. And I got the question, if we cut the corporate tax, how do we know that businesses will actually bring those jobs back here? How do we know that trade deficit will will shrink? Walk us through the steps of how we think businesses will react to the tax reform.
Right. Well, it's science, and so we can never really know anything. Economics, sometimes people say economics is the dismal science, and I like to joke that that's not fair because it's not a science. The fact is that economics is a different kind of science. It's a social science than physics, where we actually are really confident that if I drop this, it'll fall to the floor and so on. But there's a massive amount of scholarship in the space that suggests that this will happen. And the reason we should believe it'll happen is that every other country on Earth has played this experiment, and then we've watched what happens, and we can draw from a massive amount of evidence that suggests that companies will bring their stuff home, and that'll be good for workers. But you don't have to look at the latest fancy econometric literature. You could go all the way back to David Ricardo, who's really just about the first economist, who argued that when you're thinking about who bears a tax in a global economy, then mobile factors will tend to not bear taxes, because if you try to tax them, then they move. It's kind of almost tautological. But immobile factors can't move. And so if you impose a tax, then the immobile factor will end up bearing the tax. And so what's happened in the US is we tried to have a big tax, the biggest on Earth, on a mobile factor. And what happened? It moved. Right? And so then who got stuck holding the bag? The immobile factor. Who's that? The worker, because the workers don't move so much. And so we see all the econometrics and the fancy papers that say this is going to happen, but it's intuitively correct too, right? Like, so David Ricardo would tell us this is what's going to happen. And it's like such simple economics that it goes back to the very founding of the science, or the dismal science.
So all of this sounds great, but there's been some analysis coming out of shops like Tax Policy Center, and the Penn Wharton budget model has some analysis out of how tax reform could affect these factors. And they have different estimates. They say that tax reform will have a small effect on some of these things. What are their models doing differently than what you're describing?
Right, sure, there are definitely models that suggest that this will have a small effect. But we talk about this actually in our latest study, that there's a very large econometric literature that looks at how GDP growth responds when companies change their tax rates, and finds very, very large effects. There's one of the really pioneering papers in the literature was written by Christina Romer and her husband David, Romer and Romer, but the latest paper that specifically looks at just corporate taxes is by a professor at Cornell, and his co-author Mertens and Ravin, and these are just fancy, data analyses that find very large effects. Now, when you're calibrating a model that's like a big computational model, I know Heritage invested an enormous amount of money in a good one, then one of the ways you test whether your model is actually a useful tool is to see if the predictions of the model align with the evidence in the real world. And I submit that if there's all this evidence in the real world that you get this big effect, and then you have a model that says that there's no effect, then it's not the evidence that needs to look at itself, it's you. And the reason why these models get small effects is that they assume that there's a massive amount of crowding out. And so that when we cut the rate to 20%, then America's businesses want to invest and give everybody better lawnmowers and everything else. But the only way they can get the money to do that is if we all save more and consume less, so that the saving can finance the investment. And since the empirical literature on saving behavior is it doesn't respond much to things like this because people are very set in their ways in how they consume, then those models tend to not give you much capital stock growth even when you cut the tax a lot, because it has to be financed by saving. But in a global capital market, in a market where U.S. multinational firms have almost $3 trillion offshore and more going there every minute, then the capital could easily come home and finance an enormous amount of capital spending, and that wouldn't require savings behavior to change at all. It's just that there's U.S. multinational income that's being sourced abroad, and increasing the trade deficit accordingly. And so models that say that we won't have much of an effect are, one, inconsistent with the literature. Two, they tend not to have, so like the model that the Tax Policy Center uses doesn't have an international sector at all. And so there's no possibility that this money that's sitting offshore could come home. And so we shouldn't be surprised that it has a zero effect. The problem is just that if I have this model that has a zero effect and I look at all the literature and I think about the overhang of the money abroad and stuff like that, then I'd be pretty wary of going out in the public with that. It's maybe on Halloween. Yeah.
And one of the pieces, it's both the crowding out effect, but it's also how just the openness of the economy to those capital flows, right? There's lots of different assumptions as far as how much international friction there is with how much capital can flow in and out, depending on various assumptions.
Sure. But again, if capital couldn't flow like that, then we wouldn't see the wage patterns that we do in that big literature. And then you're left having to say, well, there's some reason why capital flow to the U.S. should be radically different than capital flow everywhere else. And the only place where that could maybe start to be interesting economically is just the fact that we're a very large country. And so you take a tiny little country like Luxembourg, they cut their corporate rate, then it's very easy to imagine there's enough capital to go in there and make the Luxembourg economy really sing and wages do great. But for the U.S., we have a pretty big footprint, but if you actually look at the amount of numbers we need to get the capital growth to go back to normal, to get capital deepening to go back to normal, then it's a tiny, tiny fraction of like the global capital market. And so I think that the U.S. is too big argument is the best one, but I'm not that concerned by it.
So we've talked, a lot of this hinges on the corporate tax rate is a lot of the discussion, but there's in the report that you guys release, you talk about the importance of expensing as part of this story of capital deepening and increasing investment in the United States. Can you explain what expensing is and how it fits into this puzzle?
Sure. So the idea is that if you buy a machine, then that's a cost, right? Because you had to pay for the machine. When I had to buy the lawnmower, I had to pay for the machine. And since it's a cost, then before the government taxes your profit, then you ought to be able to deduct the cost, right? And in the current tax code, you don't really get to do that. In fact, what you'll do for a typical machine, the government will say, well, we're not going to let you deduct the whole cost in 1 year. We're going to make you deduct the cost over the next 7 years. And so you can get, there's a little bit of a weird pattern, but you could say you get about 1/7 of the cost comes off before we calculate your profits. And so therefore, today, in the first year, when we tax your profits, we're really overestimating your profits because we're underestimating your cost because we're making you push some of the depreciation off into the future. And so a key part of the agreement of the Big Six, something that the president cares deeply about, something that gives a lot of bang for the buck to the tax reform, is the ability to just be realistic about costs so that businesses can deduct their true costs and expense their capital purchases in the year that they make them in order to, and then what's left over faces the profits tax, but then that's like a much more accurate measure of their profit.
And so how does expensing change, whether it's permanent or temporary? I know there's a discussion of, right now we're talking about 5 years of expensing. What's the difference between that and the permanent change?
So to be clear, that you get the biggest positive effect out of permanent tax changes, except for a few weird transitory things that we could talk about in the classroom, but not necessarily relevant now. But you want to have permanent tax changes. Sometimes given Senate rules and the Byrd Rule and things like that, the Congress has to work things out in a way where they don't accomplish what's ideal in the classroom. And I think that we're respectful of regular order and looking forward to seeing where the process leads. If expensing ends up not being permanent, if it goes out there for 5 years or something less or more, then the question for economic modelers will become, how should we model that? So if expensing did last only 5 years, then would people expect that in the 6th year we would renew it? Or did they expect that in the 6th year it would go back to what we have now? And that modeling thing is it's worthy of a whole seminar. My guess is that if I were out in the private sector modeling it, that I would expect that if it were temporary, that people would act as if it was going to be renewed after the 5th year, and that would have a big impact on my analysis.
Interesting. It's a debate that'll be going on, I'm sure,
the next few weeks
today.
Yes.
So you touched on this point a little bit, but I wanted to give you the opportunity to respond to some of the other criticisms that have come out of of the CEA reports that you have been releasing? I know there's been popular discussion in the media. There's been various different responses. Is there, I know you talked about the Summers blunder. Are there other things that you'd like to highlight that people are getting wrong about the reports that you released?
I guess I'd have to go into specifics, but I think that the reports are solid. They're based on science. There's more than 100 references in the second one, with most of them peer reviewed, and we estimate the wage effects 4 different ways and get about the same answer each time. Not because we were putting our finger on the scale, but because it's kind of the numbers align based on the laws of economics, and so I understand that tax policy in this season appears to have become a partisan issue, but it shouldn't be. I mean, it should be that everybody recognizes, as President Macron does, that if you want to be a friendly economy for workers, you need to be a friendly economy for firms, and that chasing all of our firms to Ireland was a really, really bad call, and we need to fix it. And I would hope that moving forward, as this process continues to gain momentum, that people would recognize that the appropriate way to have a tax reform is in a bipartisan fashion, and the appropriate way for a bipartisan bill to move forward is for people to show up and to say, hey, I understand this is a good idea, but I wish you did this that way instead of this way. And I think that there's plenty of good bones now to work with, and hope that we can bring more people to the table going forward.
I think this question of how other countries could respond is interesting. We were, several of us at Heritage were in Japan in February, and we met with some of their tax policy folks, and one of the things they said is we're watching what America does with their corporate tax reform most closely, because that's what's keeping us up at night. That the United States is the last one to lower our corporate tax rate from sort of international norm, and that other countries are watching what we're doing because they can see that. They see how businesses shift profits around the globe.
Yeah, I mean, it's kind of like if we were having a tax Olympics, then the U.S. is sending a team that one of the prerequisites for going to the Olympics is you have to drink a case of beer before you go run the race or something, and then we take that away, and then all of a sudden the competition's much tougher for everybody, and I think that it's a sign of how out of the game we've been, that people are really worried about what we're going to do, because they know that we're about to make America the most attractive place to invest on earth. We won't be the lowest rate, but we have so many other advantages that I think that there are going to be a heck of a lot of companies that are going to want to locate their activity here, not just U.S. multinationals, but foreign multinationals. And I wouldn't be surprised if we do cut our rate to 20%. Aparna Matter and I had a academic paper many years ago where we predicted corporate tax reforms based on the behavior of other countries. And I would suspect that if we revived that old model and thought about what would happen to other countries' corporate tax rates after we did this, then the answer would be that there'd be a lot of subsequent tax reforms around the world.
As far as this international tax competition.
Sure, and Japan has a relatively high rate still compared to many trading partners, so they probably will. Our model would suggest probably one of the first that might respond.
So right now, or probably it's wrapping up, they're releasing the additional details on tax reform, or what will move forward through the committee process. Do you anticipate what's coming out? Is that consistent with the results that you've been modeling and talking about in the CEA reports, with the $4,000 wage growth and sort of this narrative?
Yeah, I will have to examine the final details to see that legislation is different than economics in many ways, and usually when my economic paper comes out on a day, then I don't the results don't change the night before. But in a political process, that they've been negotiating stuff. I know they've been working really long hours, and since I've been going from event to event today, I've not had a chance to look at all the final details. I think they're what I think they last were, but I better study them before I answer that question.
Excellent. Well, thank you for at least partially responding to it. I guess with that, I'm going to open it up to questions in a second, but I'd like you to just touch maybe one more. We've talked around it, but this idea that businesses don't necessarily pay the tax that's being levied on them. It's passed on to the various factors, and that business tax reform is a benefit to American workers is a narrative that's easy for economists to understand, but often hard to sell to the sort of general public. And I think we're breaking through that narrative, and a lot of the things that you've been writing on and talking about are moving in that direction. But could you just spend maybe a minute on how the best way to think through how workers really benefit from this tax reform?
I think that there's two type of workers out there. There are people that have a job, and then there are people who don't have a job. And if you're somebody who doesn't have a job, then you need somebody to locate a new factory in your town. You need somebody to create a job and to put the listing in the newspaper and to give you hope. Like I can remember the times when I didn't have a job in the past that I would go through the want ads and look at, well, should I apply here? Should I apply there? And there are a lot of times when I was growing up and trying to get some extra money for comic books or whatever, that I would look at the listing and there would be almost nothing there. And so if you're somebody without a job, then your government owes you policies that make those job listings really chock full of job opportunities. And so if you're a person without a job, then the way you should think about it is there's going to be a lot of want ads out there that say we need a person who does this, we need a person who does that. If you're a person who has a job and you want your wage to go up, then really the best way to do it might be to get an outside offer, right? And so when that plant locates in your town, then you could, if your employer doesn't want to lose you, then he's going to have to raise your wage so that you don't move to the plant over there. But also, if your firm increases its activity here as opposed to in some other country, has a higher profit here, then all the evidence is that helps workers prosper as well.
Excellent. Thank you.
Thanks.
With that, I'd like to open it up to questions. Please keep your questions ending in a question mark, and let us know where you are, where your affiliation is. I saw a question hand go up in the back there first.
Birchall Wilson, formerly the chief economist at the Australian Chamber of Commerce and Industry. So I've seen corporate tax reforms fall over back home. My concern with this one is the time frame for that capital accumulation process. Now that obviously is going to be an extended period of up to a decade, and it doesn't necessarily map terribly well to the political timeframes. So unfortunately, it could end up implementing reform where you wear a lot of political damage, but the subsequent benefits manifest themselves during democratic administrations. So I wonder if you have any thoughts on that timing issue.
Well, the timing issue is a really good question, and I'm sure not an expert on politics and so on. But what happens with capital spending is that investment and capital spending is a little bit like the gift that keeps on giving. And so when we have a big reduction in the cost of capital because of a big cut in the corporate tax rate, then what happens is that you get a big surge right away in investment spending. And that investment spending leads to a surge in GDP growth right away because GDP is consumption plus investment plus government. And so that I there right in the middle goes up a lot and you get GDP. But then after the investment gets in place, then most investment doesn't depreciate 100% in a year, and so then you have higher capital stock there in the future, and then you start to get more, in the fullness of time, you get more GDP from the higher level of the capital stock over time. And so that there are two effects. One is the immediate investment effect, which immediately boosts GDP, and the second is the capital services effect, which lifts it really, for as long as the machine is there. And so you're right that this will have very serious positive growth effects even out into the 9th or 10th year, but I'm confident that you would see very big positive growth effects at the beginning because of the investment being right there next to C and the GDP accounting identity. And so, yeah.
Got a question in the front.
My name is Kami, but I'm with the Pakistani Spectator, and my question is about the media's opposition to president. Every economic indicator is up, maybe not because Donald Trump did something, but because people trust in him that he is a successful businessman, and he is trying to do the same for the country, what he did for himself. But media doesn't get it. Media just going after him. And the other question about international trade, I don't know if you know, but India has surplus trade with US, and Pakistan has the largest trade with the United States. I don't know if you have President Sear, but he is trying to kind of isolate Pakistan and make take India, Pakistan's place, what Pakistan used to do with America, like, letting America use its territory for U2 against Soviet Union. So I just wondered that if you could help to change his approach, that Pakistani Prime Minister, his family is here, part of his family is here. He was educated in George Washington University. So if he could, somehow leverage Pakistani president's affiliation with the United States and his family connection in the United States, and use him to do what Nixon did, to use China, to use Pakistan to bring China and America together. And if this President Trump could use this current Pakistani Prime Minister in the same context to bring with China together, or to bring some, not create animosity with China and just, try to take advantage of trade with China and try to take advantage of trade with Pakistan or India. Thanks.
I'll go to the first part of the question and just say that the revival of growth, I think, is attributable to two factors in the U.S. The couple of quarters of 3% growth. I think the next one will probably be about there too. One is that deregulation is already underway. And there's a big literature that suggests that the much higher regulation that we've seen in the last few years has constrained economic growth, and that the rolling back of those regulations and the more or less stopping of new regulations has had a positive effect on growth. I think that the regulatory efforts have increased sentiment that other things will change. I think you're right about that. And I think one of the sentiment things that people are most optimistic about is this tax reform. I think that if you reduce the corporate rate to 20%, that will have a big effect on American growth prospects and American businesses. I think that if the tax reform fails, then a lot of the optimism that we've seen will prove to have been false optimism, and we could go back in the other direction.
Oh, yeah.
Thanks very much. It's Dana Marsh with Transnational Strategy Group, and thanks very much, Kevin, for that really good explanation. This is a sort of a once-in-a-generation step that we're taking now, long in coming. Over this period of time, since sort of '86 maybe until now, there have been a number of other ideas that have come out, some of them fairly recently, about ways to achieve something like what I think all of us agree, sort of a focus on wages and how to boost them, get the jobs and all that. What I would find very interesting, if to the extent you can explain this, is some of the administration's thinking about how do they net out these various approaches. One approach, of course, most recently was the border adjustable tax. Another one was the possibility, or has been the possibility, of the United States adopting a value-added tax. Third is the United States opposing VATs in countries with which we have FTAs, because that kind of vitiates the impact of that. Another idea was the Delaney approach of trying to bring those $3 trillion plus back by providing tax-free for a large amount of it, and some of it would have to be invested in infrastructure bank bond, which would also, of course, create employment and jobs. Question is, I mean, how did you guys decide that this was the strategy rather than some of the alternates that have been proposed recently that were also pretty big think ideas?
Well, thanks for that question. And I think that the process goes all the way back to last winter when Secretary Mnuchin and Gary Cohn and constant communication with the president began talking to members of the House and members of the Senate about, at that point they were still talking about the border adjustment tax. And I think that there's been a very productive collaborative effort between then and now to reach the point where we're at, where we're really at the cusp of something that's very historically important. You mentioned the '86 Act. It's the biggest change in tax policy, at least going back that far. It might be bigger in some ways than that one. And that huge change in tax policy, if you look at it, it's gathering momentum. It's moving through regular order, and that means that we should respect the process that produced it. Because they've found something that's really good for the economy. I stand by our studies that say you get 3 to 5% higher GDP growth over a decade at least from just the corporate side, and that's politically feasible. And that's something that politicians have been trying to do for decades and failing. And this is a, knock on wood, a process that appears to be gathering steam.
Thank you. David Kreutzer, the Heritage Foundation. One of the things I think that's underappreciated when we're in economic malaise and recession is that a lot of the problem comes not from businesses going under, but from new businesses not starting. I was wondering if you could address how that, in addition to the deregulation and so on, how the tax rate reduction and simplification will impact new firm startups and small firms and so on.
Yeah, in fact, business destruction was bigger than business creation for, in a very unprecedented way recently. There's a study put out by the Economic Innovation Group that millennials are the least entrepreneurial cohort in American history. I think that, there's a lot of entrepreneurship that needs to be revived in this country, and that tax reform can help that. I think if you look at the House plan, that there's a special lower rate for small businesses. I think that that's meant to revive entrepreneurship. But also, I think that regulation plays a very, very important role. I mean, a while ago here in D.C., because of activity I was involved in, wanted to start a nonprofit. And you can't imagine how complicated it was to just start a nonprofit that was helping to let kids play baseball. And we're just trying to help pay for little league fees for underprivileged kids, and it was just ridiculous what we had to go through. And so imagine if you, David, and I wanted to start a business doing anything, that how much money and how much time and anxiety we'd have to spend, working through all the regulations that might impact our activities. And so I think the president's deregulation activity should revive that as well. But we have not yet studied and predicted like the specific effect of all of this on entrepreneurship. But I think it's a good to do for us to put on the list.
Question in the back.
Hey, Kevin Dyeratner from the Heritage Foundation. Was just wondering, so you talked quite a bit about the corporate tax and how it differs from other countries, particularly Ireland. I was wondering what your comments would be on the capital gains tax and how that differs with respect to the rest of the world. I've heard, for example, significant reductions of the capital gains tax, particularly zeroing it, could significantly increase investment from abroad, and was just wondering what your thoughts were on that.
Yeah, the capital gains tax enters this user cost of capital we've been talking about in a way that we could all, play within the seminar room. And so it is an important part of the puzzle. And if you want to stimulate investment, then, a lower capital gains tax would do that as well. I think that if you look at the deviation of U.S. practice from the international norm that's the most harmful, it's really the statutory corporate rate being so high. I think that the president and congressional leaders were right to make that the top priority this time.
Thank you. We got time for maybe 1-2 questions here in the back.
Sure.
Hi, I'm Joe, and I'm from the Heritage Foundation. I'm curious, which states do you think are prime and ready to receive this influx of foreign investment if the new tax rate is good enough, and what states can do to prepare themselves for any new investment?
Thanks. Yeah. So I think that if you're an employer and you want to put a plant that employs a few thousand people in the country, then you want to study our country and locate the plant in a place where you think there'll be a lot of available workers. You don't want to put the new plant right into the hottest labor market, because how are you going to find the workers? And if you do find them, you're going to have to pay them a fortune, right? And so one of the things that I'm most hopeful about, should this tax plan become law, is that when the new plant formation begins, when the companies come home, that they're not just going to come home and go into the hot labor markets that are often driven by like the young talent go to the universities and then settle around there, and then that becomes a really hot labor market, like the research triangle and so on. But rather we'll look for the distressed communities around the country where, a decade ago the factory left and the community's been trying to sort of dig itself out of a hole ever since. And if you're a smart employer, then you're going to locate in places where there are a lot of, workers that have a track record of being successful, that maybe are a little down on their luck right now, but very eager to have a job. And I think that, therefore, one might expect that plant location decisions, if the bill becomes law, would be quite geographically diffuse and wouldn't be concentrated just in the strongest markets.
In the middle, yeah.
Thank you. So I actually work at the Embassy of Ireland. I'm the economic counsellor there, and very glad how proud you are of your Irish heritage and how frequently you have caused to mention Ireland today and in the past couple of weeks as well. I just wanted to make a few points, if I may, in terms of the bilateral nature of the investment and trade relationship between Ireland and the United States. As you pointed out, there are a large number of companies, US companies with subsidiaries in Ireland, 700 or so in total. They employ around 150,000 people. Equally, though, there are 600 Irish companies with operations in the United States, employing 100,000 people in turn. Also, in terms of the basis of US investment in Ireland, a couple of things that I'd add just by way of clarification. Obviously, and unquestionably, having a competitive corporate tax rate and a pro-business approach, as our country has had for upwards of 30 years, has been a factor in attracting US investment, and no one would deny that. But you just mentioned the importance of workers. Ireland also happens to have the youngest population in Europe, one of the best educational attainment rates of any country in the OECD, and crucially, I think, access to the European single market, which, as you know, is still the world's biggest trading bloc. After Brexit, we're going to be the only country in Europe that's English-speaking, and we do have an incredible personal relationship with the United States. You are one of 35 million people in this country of Irish ancestry. So just to nuance the position a little bit, I think it's important to add that context. I'd be grateful for any comments or follow-up.
In fact, I could maybe be excused for the flaw that might be related to my heritage of being eager to share Irish wisdom with Americans, because that's really what we're doing. We're saying that the model that you adopted was tremendously successful to you, but also for you and for your workers, and even for our firms, because it helped them remain competitive when we had this uncompetitive tax system. And I think that we wouldn't be so confident in our understanding of the economic effects of these prudent policies had you not been a leader. And so I sure wouldn't.
One further thing I'd add, and thank you for that, is just in terms of salaries over the last decade, Ireland has actually had the most wage restraint of any country in the European Union. So we haven't seen a very substantial effect in terms of wage growth. Now, part of that relates to the fact that public sector workers in Ireland, myself included, took a 15% pay cut pretty uniquely of any OECD member state in response to the economic crisis. But there hasn't been a very substantial increase in wage effects either. And I think it's, again, just a relevant factor for consideration. But thank you.
Thank you for
Thank you
joining
all
us.
for coming.
We
It's
can
very
all
good to
now
see you.
go read what's in the bill text and
Yes.
figure out what
And read it
tax
before
reform
you
has
vote
in
on it,
store.
too.
Yeah, exactly.
Thank you all for having me.
Thank you for joining us.